Good afternoon, everyone, and thank you for joining us for our monthly international strategy call for August 2023. My name is Niraj Patel, and I'm the Chief Equity Strategist at Itaú. I'm joined by Marcelo Aagesen, who is the Head of Global Markets and Strategy, who is our moderator. Today, we want to mostly focus on the healthcare sector, as we have gotten a lot of questions from clients about the sector. Each month in our monthly Tech Trends video, we have been updating our clients on what has been going on in the technology sector, and most of our focus has been on artificial intelligence, but we have also been highlighting some exciting developments in the healthcare sector, as we have had some exciting news from companies regarding Alzheimer's, obesity, and many more. Besides the healthcare sector discussion, we wanted to give a brief update on second quarter earnings season, as we have gotten results from many public companies in the US and Europe. We invited Jen Nichols from Janus Henderson to give us her views on the healthcare sector. For those that don't know Janus, it is one of the largest asset managers globally, with over 300 billion in assets under management. They have international presence led by teams in Denver and London, as well as offices in Dubai, Hong Kong, Sydney, and many more. Janus offers investors a complete range of funds across equities, fixed income, multi-assets, and alternatives. I'll pass it on to Marcelo.
Thank you. Thank you, Raj, for the introduction. As Raj mentioned, I'll be moderating. I just want to say one thing before we start. As usually, we do have the option to listen to our conversation, our discussion in Portuguese. Just select. I'm going to swap to Portuguese for a second. Seleciona o botãozinho abaixo na língua e a gente pode, vocês vão poder escutar a gente em português também. A gente vai conduzir a live em inglês, mas tem a oportunidade de escutar a tradução simultânea em português. All right, so as Raj mentioned, I'll be moderating this call as usually. Happy to have you here again, Raj. And we have Jen Nichols joining us from Denver directly. Thank you, Jen, for joining us. So she works for Janus Henderson with, as Raj mentioned, above $300 billion in assets under management. Jen is a client portfolio manager, part of the investment team. She works very close to the PMs, so the portfolio managers and the analysts. We're going to focus some of the discussion in the Janus Global Life Sciences Fund, which is a 5-star overall rated fund from Morningstar. In this fund, not only a lot of specialists and people very close to the industry, but we also can count it with 3 PhDs and 1 MD as part of the analyst funds. So, Jen, I'm going to do a brief introduction of you, but please, again, thank you very much for joining us and welcome to the monthly live. Jen has over 10 years with Janus, and not only that, but also on top of that, 12 years with RVK, International Equities. So again, thank you very much for joining us. I think this is going to be a very interesting call on healthcare.
Thanks for having me. I appreciate the time today.
Of course. So why don't we kick off with a broad question, right, Jen? Why should investors care right now about healthcare sectors? What excites you and the team at Janus, and maybe what are some of the mega trends out there that you guys are focusing on, of course, in terms of healthcare?
Yeah, no, I think it's been a really exciting time to be thinking about investing in the healthcare asset class. Globally, actually. I mean, I don't know if I've been this busy in a very long time in regards to talking to clients and prospective clients about the healthcare sector and why investors really want to think about an allocation to that space. There are multiple trends that really are supportive of the growth of healthcare, not only in the short term, but long-term trends. You know, we think about innovation. When we think about how we invest in healthcare, and we'll get to that maybe a little bit later, we talk a lot about innovation and thinking about a lot of the new therapeutics that are coming to market. And we've just seen a tremendous growth of the number of new therapies, and we get really excited about the innovation. So you talked a little bit about tech and how you guys have talked about tech and AI, and you know that's been a big area of investor interest. And when we think about sectors that are able to grow really independent of what GDP is or what the economic backdrop looks like, those companies that are able to innovate are essentially able to create their own growth. So when you think about a sector that has a tremendous amount of innovation, not only in the area of therapeutics, but you even think about some of these, medical devices that are out there, robotic surgeries, things like that, that really are supportive of continued growth in the healthcare asset class. So, they're creating their own opportunities with new products that are coming to market. But then you also think about increasing demand in who's spending on healthcare. So when you think about demographic trends and you think about rising incomes in populations like India and China, two of the world's largest populations out there, you think about demographics for those people who are continuing to grow the middle class. And as people tend to increase their wealth, they really tend to spend more on their healthcare, not surprising. And then finally, aging demographics, something that is not just a phenomenon here in the US, but something that really is a global demographic trend. We like to call it the silver tsunami. So you really are seeing this aging population. We actually could see the number of people over the age of 65 actually double as a percentage of the total world population by the year 2050. And when you think about the demographic trends for people over the age of 65, they tend to spend 3 times as much on healthcare as those under the age of 65. So as the world continues to age, you continue to see more and more healthcare spend for those demographic shifts. So Marcelo, was there a question in there too? Sorry.
No, that was a great introduction. Just before we kick off to the next one, maybe I do have one question on. You mentioned one of the big trends, mega trends. It's also, which makes a lot of sense, accelerating innovation, right? And we see a lot of pump in the equity markets recently, driven by AI. How are you guys seeing AI affecting the healthcare? It's definitely there, but we haven't seen the biggest move as we saw in maybe other names. How are you guys seeing AI combined with healthcare?
Yeah, so it's interesting. As I said, I've been traveling the world talking to clients about healthcare. I don't think I leave a client meeting without somebody asking about AI. I think the trend is definitely a very hot topic. And when you think about some of the areas where you can truly see a huge impact to efficiencies and innovation, healthcare kind of jumps to mind. There's a great, I think it's a Bill Gates quote that says, we tend to overestimate what technology will do in the next 2 years, but underestimate what it'll do in 10 years. Yep. And I feel like that really applies to what you see in the healthcare asset class. I'm not sure how many headlines you've seen out there in regards to AI and how, look at this great new therapeutic that's come to market through AI and the transformation that it's had there. So maybe there's a bit of skepticism on how far AI can take us, especially in the short term. There are areas within drug development where AI can be incredibly powerful and make the process more efficient. So if you think about the fact that it takes on average 10 years and about $1 to $2 billion to bring a new drug to market, where you can see a lot of that efficiency through AI is really in those early stages of drug development, when you think about identifying targets that you're looking for or molecular structures that you're looking to have for some of these therapeutics. So what we've seen today so far is that a lot of the AI hype that you're seeing really is more in those early stages of the therapeutics and drug development. You still have the clinical trial process. So AI could help you in recruiting patients for clinical trials, but AI as it stands today can't really take the place of actual clinical trials. Yeah. Having those patients actually take those therapeutics, decide if they are efficacious, if they're safe, things of that nature. So I would say that hype is probably a little bit more there than there is reality, but the promise of what AI can do, not only in drug development, but also thinking about other areas of the healthcare system and making the healthcare system more efficient, could actually be pretty transformative.
Yeah, that makes a lot of sense. Thank you. Just before I go to the next question, Raj, there's one thing that I would like to ask you. So we do track global equities. You cover US, Europe, Japan, but also we try to look into sectors, right? And healthcare is one of the sectors that you like the most, alongside with tech, probably.
Yep.
How are you perceiving how you perceive the market? Why do you like healthcare above all the other sectors?
Yeah, I mean, we have in terms of sector views, the three that we like, the two that are the most defensive, technology and healthcare. So obviously there's secular growth with both, but also there's not as much economic volatility, right? In a recession, healthcare is, and again, Jen is the expert here, so I'm probably chiming in where we have someone that's an expert. But I like the fact that there's been this debate for the last, it feels like forever. Are we going into recession? Are we not? And so that debate, when you think about it, if you own healthcare, you don't have to think about that. That's one less thing to worry about. And then you have some of the drivers that Jen has mentioned. So that is the one reason, and the better growth prospects, right? So if you have better growth, less downside, when we talk to clients where to allocate, there's less cyclicality. The last place we've talked about energy, it's a very cyclical, very different, but maybe with what's going on with OPEC and other things, and China recovering, there could be something there for energy, which is a very different sector. But tech and healthcare do have a lot of similarities, like I mentioned, around the defensiveness of it. You could say one has now a very different multiple. If you look at the spread between yeah, just a little bit. Yeah. And the other thing is it's important for the economy. If you look at the U.S. economy in terms of how big healthcare is, and also within the S&P 500, it's a big sector. So I think it's important. When I think you asked Jen, why is it important or why should they care? It is a large sector, both from an economic standpoint and from
roughly 15 or something, 13%. All right, no, that's good. Thank you. So Jen, back to you, if you don't mind. Given the fact that we are taking advantage of you being the specialist here, we're gonna maybe go a little bit deeper. If you don't mind, give us a little bit of your view or the fund's view in terms of subsectors within healthcare. How are you guys looking at this?
Yeah, so maybe even just commenting a little bit about Raj in his comments. I think he stole a little bit of our playbook here in regards to why we like healthcare. And I think he also hit on something on valuation as well. So hopefully that wasn't lost on the audience. Last year was one of a great year for healthcare. When you think about healthcare and being defensive, healthcare is typically only capturing about 47% of the drawdown. When you see the equity markets decline, healthcare was one of the best performing sectors last year. I think we're seeing the reverse of that this year. Healthcare has lagged quite a bit. Raj could probably comment on that in regards to multiples, and hopefully we'll see that start to shift as maybe the multiples are a little bit richer on the tech side than they are from a healthcare perspective. So broadly, we think that the asset class is really attractive, but even within healthcare, as you start to dig in a little bit deeper, there are multiple sectors that really tend to look and feel very different within the healthcare landscape. How we tend to break up our portfolio and how we think about healthcare asset class is really thinking about pharmaceuticals. So, you're thinking about those large companies that you're probably all very familiar with that make a lot of the name brand drugs out there. You've got the area of biotech, which tends to be a bit more of the innovative areas. A lot of great return opportunity, also a lot more risk, a lot of innovation coming to market from biotech. You've got areas like healthcare services, like the insurance companies. You've also got areas that, we call med tech and devices. So think about those things. So I'm a diabetic. So, I was just looking at my phone because my Dexcom was going off and telling me what my blood sugar is. So you think about a lot of the technology that goes into healthcare. So the healthcare asset class really attractive from our perspective, as Raj mentioned, but even within the subsectors, we tend to have a really balanced approach. So we think about our portfolio really being balanced across pharmaceuticals, biotech, and then we kind of lump together everything else. So the med tech, devices, services, all kind of together. So roughly think about our portfolio as being a third across all three of those subsectors. So that means that we tend to have an overweight to the truly innovative area of healthcare in biotech, and we tend to be underweight the area that's a bit more defensive within the pharmaceutical area. So when we think about where the opportunities are within healthcare, we really think if you want exposure to a lot of that innovation in healthcare, then you really do need to have greater exposure to biotech. So even thinking about that exposure to the S&P 500, a lot of that healthcare, you're really missing a lot of the biotech exposure, and more specifically, small and mid-cap areas of biotech. So when you think about our portfolio, we do tend to be pretty diversified We like pharma for the durability, for the defensive characteristics. That's why you still see it a third of our portfolio. But we really like the biotech space. That's why you see it another third. So, 2/3 are roughly in the area of therapeutics. Valuations still remain incredibly compelling in biotech. You're seeing a tremendous amount of innovation, new therapies coming to market. Not only are new therapies coming to market, but those drugs that are coming to market are actually more profitable. There's a lot more revenues associated with these new therapeutics. And then we've got another third for the other areas of innovation like medtech devices and even some more durability within health insurance. So we do tend to be more balanced across those subsectors because of where we find the most attractive opportunities in healthcare.
Yeah, no, that's great. And another thing that I want to ask you, we briefly discussed AI, and that's probably not what's driven the innovation right now. I like the quote, by the way, that we tend to overestimate what we can do in 1 year, underestimate what we can do in 10. So what is actually driving the accelerating innovation, if not AI and all the things that we are seeing from your perspective?
Yeah, so I think there are really two key components that have really driven the rise in the number of new drugs that have come to market. And I would say one's kind of on the clinical side, one's going to be more on the regulatory front. So we really started to see kind of a pickup in the number of drugs coming to market after we really did the Human Genome Project. Probably going to date myself a little bit here, but I remember when I was in high school and we were still, the world was still working on this Human Genome Project, and it took 13 years and $3 billion to actually get this project completed. But what an incredible feat that we had. And now here we are, we can sequence the DNA within an afternoon and we can do it for less than $600. So it's pretty incredible to see what we've been able to do from a genetic sequencing standpoint and how that's really enabled us to, identify diseases better, identify new therapeutics better. We talk about oncology, and you talk about more targeted therapeutics of really identifying the genetic makeup of a certain cancer cell and how do we have a better therapy to target that. So really having that advancement in genetic sequencing has really been a huge step in that progress. But you also see it on the regulatory front too. So when you think about the FDA and the FDA being the one that actually is approving these drugs to go to market, historically, pharma companies would go out there, they'd do all this research, they'd do these clinical trials, they'd spend all this money, and then they basically bring their report to the FDA at the end of the day and hope that it's what the FDA was looking for in regards to getting these drugs approved. So it was like taking a test without actually knowing what you were truly studying for. Well, turns out that's probably not an effective way to really use those R&D dollars to actually bring therapies to market that these patients actually need at the end of the day. So the FDA really kind of changed a lot of the, the way that they worked and started actually working with pharma and biotech companies to be much more collaborative so that they could actually work together to bring these therapies to market for patients. So you were actually being much more efficient with those dollars when you were going out and doing these clinical trials and developing these drugs. So kind of a combination of the advancements that we've seen on the science side, but also what you were seeing from a regulatory front, really kind of working together to help bring drugs to market more efficiently than we had in years past.
Can I link the last piece of your answer with a question that we got? Some of the clients that we talked to, including this client, think, especially on the regulatory front, right? That there's kind of a binary component, especially when we talk about FDA. And keep in mind that the majority of our client base is Brazilian, so understanding the whole complex environment is not easy, even for American as a whole, but especially for Brazil. So, and maybe I can add the question, how important it is to have very specialized people, including MDs and PhDs in the team, in terms of understanding how that plays and how binary it really is, or if you can actually forecast stuff. Because I feel there is a little bit of, I wouldn't call gambling, but definitely trying to bet in the right horses, right?
And also a lot of my travels, it's been interesting to see how many clients I've talked to that would say that they got blown up in biotech. which is definitely possible because to your point, that very binary aspect, especially within biotech. And drug development in and of itself is binary. I would say for the pharmaceutical companies, it's less important on the stock price because those companies are so large that one clinical trial hiccup or blow up isn't going to destroy the value of the company. But some of these biotech companies, that will definitely be the case. So when we think about the binary nature, so much of it is really on the clinical trial process. So if you think about the fact that 90% of drugs that enter human clinical trials don't make it all the way through to an FDA approval, that's only a 10% hit rate. So that's not a very good hit rate in regards to looking at some of these development stage companies. So when you have a team of analysts, so we've got a PhD in immunology, we have a PhD in medical physics and engineering, we have a PhD in medicinal chemistry, we have an MD. So they really understand the science of what is going into these therapeutics. They really understand the science of even the indications or kind of the therapies, diseases that these therapies are going after as well. A lot of them have actually been a part of clinical research before coming to the investment side. They understand how clinical trial design should work. What are some of the endpoints you should be looking at? What's the statistical significance that you're trying to look for in some of these phases of the clinical trial process? So having a team that can really get into the nitty-gritty of all of those details, I think is actually table stakes. I think it's really hard for generalist investors to really come in to these binary stocks and really try to discern if this company is going to be successful with, to your point, without gambling. So that is one key component of that. I would say then, yes, you do have the FDA component, that regulatory risk. The FDA has become a little bit more, I would say, predictable nowadays than it had in years past. So there's less, I would say, less of that binary nature when it comes to the FDA, and there's always some area of uncertainty when you think about what drugs are actually going to be approved. But then you also have the other piece of it. It's not just that you brought the drug to market, you actually then have to successfully launch it in the market, because if you can't be successful in you bringing revenues from those therapies, you basically just wasted $1 billion bringing a drug to market that isn't going to be successful. So yes, the hard part is really getting to an FDA approval and getting through clinical trial, but you also need to get the other side of that right. Are these drugs going to launch successfully? Are they going to take market share? Kind of think about the different aspects of what makes it successful once you go to market as well. So we really think that there are multiple pieces that you need to get right, and really investing behind a team that truly understands not only the science, but also the business aspect of it is incredibly important when you're investing in biotech specifically.
Yeah. Changing gears just for a second. Another thing that you mentioned, which it's part of the secular growth, that Raj also referred to, it's aging population. I think this is a big drive for the long term here, definitely. And I didn't know about the data that you mentioned. 3 times spending for people over 65. That's huge, especially if you're thinking that we have more people crossing that line. But another big drive here is specific disease that we think they're going to have some sort of breakthrough in the next few years. Right. So what are you guys seeing in terms of what are the specific categories of disease that you think will see some big innovations the next decade or so?
Yeah, no, I think there's so many interesting areas of opportunity. Oncology is one of them. So cancer, it's predicted that 40% of the population will be diagnosed with cancer at some point in their life. And, maybe this is also kind of tied to the obesity, and we'll get that as well. It's not surprising that roughly a third of new therapies that get approved every year are in the area of oncology. So when you think about a high unmet medical need, that still continues to be an area where you're seeing a tremendous amount of R&D and innovation come to market. And one area that we've seen a lot of progress is in the area of antibody drug conjugates. So this much more targeted approach to curing cancer, or at least improving the survival rates of these patients. We've got, there's a company out there, Immunogen, that actually had a drug approved for ovarian cancer in this type of platform. And then they recently had some great data for think it was blood cancers that they were trying to target, but they were having very similar efficacy in this additional indication of cancer, which could really mean that ImmunoGen could essentially have a platform for their antibody drug conjugates, or what people call an ADC, for all sorts of types of cancer, which could be incredibly transformative. So, you know, when you think about a high unmet medical need where you're seeing a lot of new drugs come to market and new drugs that are having much better effects on patients, you know, that's always going to be a key piece of what we have exposure to. You touched on some of them with Alzheimer's. I mean, we used to think about Alzheimer's as being kind of the great white whale of healthcare, of this disease that we really didn't understand well enough to know what caused it. So therefore, how are we trying to treat or bring therapies to market for these Alzheimer's patients? And as we continue to age, the number of patients with Alzheimer's continues to increase. It's incredible to me that there are more people that actually die of Alzheimer's than prostate and breast cancer combined. So when you think about a huge unmet medical need, Alzheimer's has been an area where we've been working for years to bring new therapies to market. We've had 2 drugs already approved, I would say with kind of increasing efficacy and use out there. The first one, probably not going to be used. Second one, it's, you know, you're at least getting a little bit more traction, and actually we should have a 3rd Alzheimer's drug that could be even more efficacious, could be easier for patients to take, could have a better safety profile than what's already approved. So we're continuing to make progress when we think about these therapies in addressing the Alzheimer's need. And it's a huge market out there. So we've been really excited about these companies that are looking to bring therapies to market in that space. And then, you know, a lot of those big pharma companies that are also working on Alzheimer's are actually working on obesity as well. So, you know, pun or not pun intended, obesity being a rather large market globally, there are so many patients that really could benefit from these therapies. I mean, when you're seeing some of these new statistics out there, you're actually having a weight loss success that's almost the same percentage that you're seeing for surgical procedures. So if you can take a therapeutic instead of having surgery to, you know, lose anywhere from 20 to 25% of your body weight, that's absolutely incredible. And you think about the secondary effects of obesity. I mean, the #1 risk factor for cancer is actually obesity. So, you know, if you can basically solve for this problem for obesity, you can help those patients in treatment of diabetes, cancer, cardiac events, high cholesterol, all sorts of other secondary issues that really impact those patients. So not only are you improving the lives of these obese people, but you're also making the healthcare system more efficient, because we're spending trillions a year on caring for obese patients and all the secondary health consequences caused from obesity. So if we can really solve that puzzle, so to speak, you know, that could be incredibly transformative both for patients and the healthcare system.
Yeah.
And those are just some of them. I mean, those are the well-known stuff. There's a ton of rare diseases and genetic diseases and, you know, huge advancements that we see in that space that probably get less attention than some of these more headline-catching indications.
Yeah, no, and I can tell that you're very excited. And so another question that I got, and it makes, I think I can link to the discussion we have right now, is I'm assuming you're also constructive and positive in terms of timing to join the sector, or being a little bit overweight, and just like Raj, I think for a more top-down approach from your perspective, but definitely you have the details and all the complex stuff of or even the subsectors. But what are the biggest risks that you see right now for either for the subsectors or for healthcare as a whole, in terms of evaluation? Is there maybe it's kind of protected from a possible recession, but what is coming your way that makes you concerned?
I would say from our perspective, valuations still are really attractive. I would say for the healthcare asset class broadly, it still trades at a discount versus the broader equity markets, definitely versus tech. Even when you go into biotech, that area still is pretty inexpensive, especially after facing a drawdown that we saw in the biotech sector. So from a valuation perspective, we don't necessarily think that that's a risk at the moment. recession, as you mentioned, I mean, healthcare tends to be a pretty resilient place to be. So, I think Raj and I are agreed here on, like, we feel like we keep kicking the can down the road in regards to when we're going to have a recession, if we have a recession at all. So who knows if it actually comes, but if we do end up in a recession, healthcare tends to be very resilient. We saw a lot of that last year. And so we don't necessarily think that the economic landscape is a cause for concern for us. I think for healthcare, probably the biggest concern out there, especially as we end up in the next presidential election cycle here in the U.S., which looks to be 4 years ago, 2.0. Still TBD as to who our Republican candidate is going to be. But I would say regulatory concern tends to be the biggest concern for healthcare. However, with the caveat being we did pass the Inflation Reduction Act last year, which did give us some kind of visibility of where we think drug pricing is going to be. So it's maybe less of a concern this go round than, say, the last two presidential election cycles, where healthcare clearly was a bit of a punching bag for some of the Democratic nominees especially. But I would say that's always kind of the biggest concern.
Yeah.
In the near term, it's really the regulatory risk.
And do you think that affects kind of equally the three subsectors that you refer to? So pharma, everything, or more the biotech and maybe pharma? How do you?
Yeah, more biotech and pharma. Those tend to be the areas where you get the biggest concern around drug pricing. Last election cycle, we had Medicare for All with Bernie Sanders and Elizabeth Warren. That's not an issue this time around. So you did see that the health insurance companies were impacted last time. We don't really expect that this go round, considering, we know Biden obviously is the Democratic nominee, and it's less of a Republican issue. So even if Trump isn't the one that gets elected, it doesn't tend to be much of an issue on the side of the Republicans.
All right. That's very good. Thank you, Jen. I'm going to switch gears briefly to you and second quarter earnings, Raj. Again, slightly different. We have a view on equities, but anything that you're seeing in terms, not only in terms of healthcare, but how are you perceiving the equity market, US?
Yeah, I mean, in terms of earnings, we're a little over halfway through the earnings season, so we still have a ways to go. There have been a few of the healthcare sector companies that have reported earnings. I think Merck this morning reported, and so you're starting to get some healthcare related earnings. I guess one topic that's been out there is that some of the life science equipment companies like Danaher, Thermo Fisher, Agilent had slightly weaker results. Some of it's, the customers are spending a little bit less. China is also an issue. It's not just for them, but there was an expectation that China was going to recover, and that the life science equipment companies like Danaher do have a portion of their business is tied to China, and so does Thermo Fisher, and that's not coming through as expected. So that's maybe on the healthcare side. If you look on the overall macro S&P 500 earnings, they're currently beating at a rate that's slightly above the average. So on average, companies beat earnings, right? We all kind of know that they do. They set the expectations so they can beat. They're right now beating at a range of around 6% more than consensus, and the historical range is 4 to 5%. So that gives you a rough sense. I guess one observation is that the stock price reaction has not been as positive, despite the positive in earnings. I mean, obviously we're seeing the overall market has performed well for the month of July, but if you look at the price reaction after, people like to look at what is the 1 day performance or 2 day or 3 day after the earnings report. You're not seeing the same magnitude for individual stocks if you break it down. And then if you look at sectors, financials actually had a good month for July. If you look at sectors that did well in July, financials, energy, because we had a rebound in oil, communication services, because Meta and Alphabet had good results that took both of those stocks up. But financials, there's been worries since March, right? Silicon Valley, First Republic. And so you finally saw the large banks report, and it was better than feared. So I think financials had a good month because of the relief rally from earnings. So that's maybe just a quick synopsis of kind of earnings. But we're still, like I said, a little over halfway through, and we still have the big U.S. retailers. They don't report until middle to end of August. So we'll see what companies like Walmart and Target and others say about second quarter, but also back to school. What are they thinking about third quarter? So we still have some data to come, but that's going to be a quick recap.
No, that's great. But let me ask you one thing. Even if it's slightly weaker, let's call upside surprise in terms of equities earnings, if we gauge market concerns or investors' concern based on implied vol, it's still very depressed.
The
right?
VIX is at very low levels.
Very low levels. If you compare to the fixed income interest volatility, the MOVE index, it's opening up quite a boca de jacaré, quite a gap between those two.
I got my Portuguese. That was the gap, right?
I know, yeah. We've been training Raj for quite a while in Portuguese slang. He's improving quite a lot. You lost my, but anyway.
The gap between the VIX and the MOVE.
Yeah, so VIX is still very depressed. So it doesn't feel that the market it's super concerned right now. We're actually buying vol right now. So in the trading desks and all of our teams are protection or whatever through any kind of instruments. Put seems to be cheap right now in terms of historical volatility. What would make markets to be a little bit more concerned right now, or what is your view on
I mean, look, I think, and feels like Jen said, the two of us are going back and forth discussing similar topics. The recession fear that keeps getting kicked down. If you look at now, I mean, 4 or 5 months ago, I think everyone thought we were going into recession, right? That's why the markets, and if you go to October, is even more fearful. Yeah. Now, if no one thinks we're going into recession, right? It's like, what are you talking about recession? You know, so the sentiment has swung. Again, we're going to be watching data points every month, and like everything, you know, there are month-to-month ebbs and flows of data. So I'm sure there will be a month when consumer spending maybe comes in a little bit weaker, maybe the jobs number comes in a little bit worse, and that will reignite some of these fears of, okay, is there a recession coming? I mean, a recession, again, you need 2 quarters of broad-based weakness in the economy, but the market will look at 1 month and say, oh, you know, I need to now worry about that. You know, the other piece that's helped the equity markets and brought VIX down is the view that inflation is coming down.
Yeah.
Right. So if you look at we've had a few months of good inflation data relative to expectations, but we're not back to 2%. Right. It doesn't feel like it, especially in Miami. Right. We're a long way from inflation coming down. But you know, the question again is if that reaccelerates. I mean, there's a debate if you talk to economists, there's different views on where we end up at the end of the year and where it's what's the neutral rate and all these other debates, which is why the MOVE index is high, right? Because I think there's probably more concerns or volatility around inflation. So when it goes back to equities, for now, the soft landing that everyone now seems to believe will probably get challenged at some point because of a data point here or there. And so that would, probably create some volatility. But I mean, the biggest factor is always the unknown, right? I mean, there are things out there that we don't know. That COVID was not a known. It was unknown. So there's always something that will come up that we'll not know about, and hopefully.
So are you blaming healthcare?
Healthcare saved the world.
All right.
We got us out of COVID, right? But yeah, that's, I think, the unknowns, right? I think, we're gonna, this is why we all monitor the news. We see what's going on with companies, but we want to see what's going on. Russia, Ukraine is still ongoing. Yeah. There's always the geopolitical risk around the China, Taiwan, U.S. Relationship. One thing that Jen mentioned, the election. I was in Brazil recently, and I got questions on the election. I think most of us here, we see it constantly with what's going on in the news and the media, right? You can't escape it. But in Brazil, it's actually refreshing because no one talks about the election until now. The few times I went earlier, it was not brought up, but now I got the question: what is it going to be like next year when you have Trump and Biden? And it's going to be probably volatile and a little chaotic at times because of how the market perceives what happens. Ultimately, I think even Jen pointed out, it wouldn't matter for whether it's healthcare or for the overall market. It tends to be short-term volatility. But you ask what can cause the market to become more volatile, what can cause the VIX. The election could cause some short-term, volatility.
So let me change the question a little bit. We're neutral overall U.S. equities, right? What would make you change during the committee? Of course, change your view either positively or negatively.
Yeah. So our overall allocation is we are overweight equities. So we do have an overweight equity allocation, but we've expressed it through emerging market equities. So EM and the combination
has been good so far. Yeah.
It's been good, but to be fair, U.S. equities have done really well.
Yeah.
So it's been a global equity market rally. The reason why we picked emerging markets was because of the weak dollar view, which has played out, but also China recovery, reopening post-COVID, and the economic activity recovering. There's now more debate around China, clearly. It's been kind of a stop and go, whether we get more stimulus and how that progresses. With the U.S., but the valuation at this level is a concern, right? Not on healthcare. Jen, I didn't mean to contradict what you had to say. So healthcare is different, but if you look at tech, right? I mean, the large cap technology sector is trading at 30 times earnings, while the rest of the market is trading much lower. So you have this dichotomy. But if you look at it on average, the S&P is now trading at a premium over its 5-year history. So if you look at the 5-year earnings multiple, forward earnings, it's around 18.5 times, 19 times. We're at 20, right? So we're at a slight premium. But if you look longer term, if you look beyond the 5-year, if you look at a 10-year, the average is 16, 17. So you're trading at even bigger multiple difference right now in terms of premium. So I think the multiple has to probably, for the overall market, has to be a little bit more reasonable to say, okay, and our views are 12 to 18 month out, right? So to say on a 12 to 18 month basis, when we're trading at a premium, I think we'd rather see the...
Quando estamos com premium, isso ajudaria nas expectativas de ganhos, né, que fossem um pouco mais altas. É claro que os estrategistas estão preocupados, então, de certa forma, eles estão colocando expectativas ou estimativas mais baixas.
Reasonable levels of earnings, so there might not be as much of upside to earnings revisions that you saw over the last 6 months. I honestly did not think that the earnings revision the multiple repricing would happen as fast, but we saw a big multiple decrease. It went from 23 times earnings to 15, 16, and we snapped back to 20 very quickly, right? And so I think that's what maybe surprised me and others, but we were neutral. So I think a lot of other
neutral mean we are allocated.
Yeah, but we
are overweight.
And equities, and a lot of other places were more cautious, underweight, and so I think we at least struck the right balance. And so that's kind of how I think about U.S. And we moved from a world of TINA. There is no alternative to. There are lots of alternatives, and there's a bunch of acronyms, but you can buy a 2 or 3 year investment grade bond and generate some pretty good yield.
Opportunity cost showed up as well.
Yeah, so I think that's the way that we think about this from a strategy team perspective.
Makes a lot of sense.
And it doesn't mean that there's not opportunities in the market.
Yeah, no.
And that's why we brought Jen in from Janus, is because healthcare, multiples are actually
depressed
discount versus the market. So when there's clients that are asking what to do, there are places within the equity market. So it's not always I need it's neutral.
One size.
Yeah, it's such a dynamic market that there are opportunities. So I think the message here is that there are opportunities, and healthcare is one of them. That's why we brought Jen.
Makes sense. That's great. And by the way, this has been very interesting so far. Jen, let me ask you one thing that I received from the audience as well. I'm not sure. Do you guys have any? Well, we mentioned India, China. Of course, we've been focused on the U.S. quite a lot. Do you have a global view on specific countries or regions, or do you only look at U.S.? Do you have any kind of geographical preference right now?
Well, so maybe a few different ways to address that question. So one, we do have a global strategy. So when you think about our global life science strategy, we are global in nature, but we do tend to be pretty overweight the U.S. So roughly 80% of our portfolio tends to be in U.S. companies. But a lot of that really is driven from our biotech weighting. So when you think about the biotech subsector, a lot of that really is in the U.S. Most of the kind of more mature area of the biotech industry tends to be in the U.S. There is some in Europe. You do see some in China and other areas. But when we think about where a lot of the opportunity is, it really is in the U.S. So when you think about our exposure, really is coming from bottom up. We don't take a look at the world and say we need to be more or less exposed to a particular region. Our pharma analyst, she might take a look at her space because it is very heavily skewed to U.S. and pharma. She might say from a bottom up, Europe is looking more attractive from a valuation standpoint, so maybe we'll incrementally increase our exposure to European pharma over U.S. pharma. but typically we're not looking at the world and saying, okay, from a top-down perspective, how do we think about allocating? It really is driven from the bottom up, but we do tend to be more overweight to the U.S.
All right, all right. That's great. Any final thoughts or comments or anything that you would like to mention, either about the fund or the sector specifically, Jen? That would be great to hear your thoughts.
Yeah, so, I think, Raj kind of teed me up nicely in his last comments about, looking at broad equities and thinking about the attractiveness. So you can think about the asset class very broadly, but even within equities, where do you find the opportunities? Healthcare is a great place to be in. I think tech has really kind of sucked a lot of the air out of the room. I think you see that in the multiples in the tech sector. So if you're really looking to gain exposure to an area of the market that can be resilient in a variety of market environments, where you have a lot of upside opportunity with the innovation that you have in the sector, trading at valuations that are at a discount to broader equity markets, I think healthcare really looks to be an attractive place to be going forward, kind of regardless of what we think the market environment's going to be in, especially if we don't end up in this recession. You still have the opportunity for growth in an area where we're seeing could have a record number of new therapies come to market this year. So the fundamentals also really support kind of right now as being a good time to be thinking about healthcare and even our biotech exposure specifically. And if you're going to invest in healthcare, you really should do so with a team of experts, with our 3 PhDs and MD that we have on the team who really understand the science and the business of these companies to really help to pick the winners from the losers in, I would say, has the widest dispersion of returns versus any other sector. So invest with the experts if you're going to invest in the healthcare asset class.
Awesome. That's a great comment. Thank you again very much for joining us. It was a pleasure having you here. I do hope that we see you again. So thank you very much, Raj. Thank you, as usual, for the partnership. Thank you all of our clients, and I wish you all a great afternoon, and I see you next time.
Thanks, Jen.
Thank you.
Bye.